Tesla stock is on the rise and is currently trading at around $217 as of writing. Tesla stock has gained 8.4% in the past week and 33% over the past month. There's been a lot of positive news coming Tesla's way, with Tesla's all models qualifying for the EV tax credit to developing a refreshed Model 3 with the Project Highland and also with the Cybertruck nearing its deliveries. Investors are looking forward. With the EV tax credits, Tesla is poised to receive around $41 billion in credits by the end of 2032. I'll make a detailed video on that topic very soon, as this video is meant for what's currently going on with the economy. If you're going to hold the stock for the long term, then Tesla shareholders have nothing to worry, as we might see some volatility due to the Fed's monetary policies. The Fed's been ramping up quantitative tightening. Also, I'm going to explain to you what's currently happening with our economy, along with the Fed pause and the Fed pivot. Let's start with the quantitative tightening. For the first week of May, the Fed removed $43.5 billion. During the second week of May, the Fed added $100 million. It's been a while since the Fed has added money. During the third week, the Fed removed $30.2 billion. During the fourth week of May, the Fed removed $4 billion. And on May 31st, the Fed removed $43.3 billion. So for the month of May, the Fed has removed a total of $120.9 billion. That's a lot compared to the previous months. During April, the Fed removed $82.3 billion. So the Fed's ramping up the quantitative tightening. All this data is publicly available, and you can check it if you want. If you want regular updates on quantitative tightening along with other economic information, please subscribe to my second channel, where I update regularly with what's happening in our economy. The jobs report for the month of May was released, and it exceeded expectations. Along with that, the debt ceiling crisis is over. The market's really loving this, and we can see that in the stock market. Along with this, we all know the Fed is raising interest rates. The current rate is at 5.25%, when the Fed raised 0.25% during their last FOMC meeting on May 3rd. We don't know if this is the last rate hike during this economic cycle, but the Fed has to pause interest rate hikes sooner or later. Also, they can't keep the interest rate hikes at the same level for too long. The corporate profits will decrease, the economy will suffer, which will in turn reflect it in the GDP, and this put pressure on the stock market. That's why Q2 numbers are very, very important. The GDP is coming down rapidly. Also, during the recently released Fed minutes, Jerome Powell said the GDP will degrade in Q2 and Q3. Yes, we're still in positive territory. The Q2 GDP, which will be reported in Q3, my expectations is we might be in negative. During the Q1, we were 1.1%, which was well below the estimates. We were down to 1.1 from 2.6% from the previous quarter and 3.2 before that. During the recently released Fed minutes, Fed Chairman Jerome Powell indicated they might do a hop instead of a pause. It means they'll pause for now, and if the inflation doesn't come down, they'll increase the rate again. If they do increase, that's going to be a disaster for the stock market. During the last 60 years, whenever the Fed pauses the interest rate hikes, the stock is up 6% on average in 2 to 3 months. Also, historically, when the Fed cut interest rates, the stock market knew lows in that economic cycle 7 out of 9 times. On average, the stock market has fallen 23%. The 2 times the stock market didn't fall were in 1989 and 1995. During the 2 times inflation was around 2 to 3% range. Let me put that in simpler terms. If the Federal Reserve decides to pause on June 14th, it's likely that the stock market will go up about 6% for 3 months. However, during a period of high inflation, the Federal Reserve may have to keep interest rates higher for a longer period of time, which could slow down growth, cause corporate profits to fall, and put downward pressure on the stock market. When the Federal Reserve pivots and starts cutting interest rates, it usually results in the stock market falling by an average of 23% from the final rate hike. This has happened 7 out of 9 times. It's important to keep in mind that the data we discussed earlier are averages, so the stock market could perform better or worse than expected. Out of 9 instances, the stock market has fallen 7 times when the Federal Reserve pivots and starts cutting interest rates. The only 2 times it didn't fall were in 1989 and 1995, when inflation was low and the economy was doing well. Therefore, it's more likely that the stock market will fall when the Federal Reserve pivots. Currently, our economic landscape is different from 1989 and 1995 because GDP is trending downward and inflation is above 3%. Moving on to the upcoming FOMC meeting, there's a question of whether the Federal Reserve will pause or continue raising interest rates. Over the past 14 months, the Federal Reserve has raised interest rates 10 times, totaling to 5%, and the current FED funds rate is at 5.25%. The upcoming Federal Reserve FOMC meeting concludes on June 14th, and the question is whether they will pause and keep interest rates at 5.25% or hike again by a quarter point to take it up to 5.5%. When Powell spoke at the Fed conference, he indicated that they're going to pause. According to Powell, the current rates are high enough to suppress borrowing, spending, and economic growth. He also said that they can afford to look at the data and make careful assessments before making any decisions. Powell is suggesting a pause because of the lag effect. It takes time for the interest rate hikes to damage the economy, and the data shows that the economy is slowing down. For instance, the latest GDP report came in below expectations, indicating a significant drop. Powell wants to avoid overdoing the damage and triggering a worse recession than necessary. The Federal Reserve can pause, pivot, or hop, and on June 14th, it may not be a pause, it may be a hop, which is pause now and raise later. However, it's important to remember the purpose of these interest rate increases, which is to slow down the economy and inflation. The health of the banks and credit flow is also a crucial variable, and Jerome Powell is taking this into consideration. He said that stress in the banking sector may slow down the economy enough for the Federal Reserve to be less aggressive with their interest rate policy. So I want you to remember that. The health of the banks and credit flow is very important during the next few months that'll determine the interest rate hikes, and Jerome Powell is taking this into consideration. He said very clearly that stress in the banking sector may slow down the economy enough where the Federal Reserve can afford to be less aggressive with their interest rate policy. Regardless of what they decide to do at the FOMC meeting on June 14th, if credit conditions tighten, it may result in a pause rather than a hop. Tighter credit conditions are equivalent to an interest rate increase or two, and the Federal Reserve doesn't want to overshoot and trigger a deeper recession than necessary. The market's coming to the realization that Powell is serious when he says that there will be no interest rate cuts in 2023, but they still don't give him full credibility. The probability of a Federal Reserve cutting interest rates in September is currently around 20%, down from 40% not too long ago. The market still expects it to happen in 2023, but they've pushed that expectation back to November this year. If you're an investor, please be patient. Easy monetary policies are going to come back. The Fed cannot sustain a high interest rate environment for too long. The Fed eventually would have to reduce the interest rates and turn back the money printer on. The Fed prints money, the stocks go up. The Fed takes money, the stock market goes down. You don't fight the Fed. The problem lies not in the stock market, but in the debt market. Look at the 10-year yield curve. The 10-year yield is inverted. As the interest rates rise, the Fed needs to pay more interest on the debt. They're no exception and have a budget. Cryptos are going to react faster than stocks. Once that happens, the Fed's going to pivot. That's when the Fed will reduce the interest rates again and start the money printers back on, and this will skyrocket the stock market and crypto market. However, there's going to be a trade-off. The trade-off is going to be more inflation. The inflation's going to be worse than the current levels. It's not just the stock market. The government tax revenue will go up because of this. The government loves this. It soared in 2020 and in 2021 from capital gains. Even the state government collected a record amount of taxes due to capital gains. Just think about what will happen to the tax revenue this year and next year. How's the stock market doing this year? If you don't make any money from the stock market, the government will not be able to collect taxes from your capital gains. The Fed needs money because of the high interest rates, and they'll get hit as well. For all reasons, financial and political, the Federal Reserve will start printing again. They'll have no choice. The Fed cannot survive the deflationary environment. That's because they cannot tax deflation. They need inflation to pay for the old debt. Therefore, the Fed will turn the money printers back on. When that happens, we're going to have more inflation, including the stock market. This is just my prediction for now. When will the Fed turn the money printers back on? When the Fed starts printing money, they won't do it randomly. The Fed will announce it, You should pay attention to the monthly CPI, PCE reports, and FOMC meetings and form your own opinion and don't follow anyone blindly. Also, you need to track quantitative tightening. You can check this on the Federal Reserve website. You can see how much money they've been removing from the economy and how the market's been reacting. Also, the 10-year yield curve. The higher the yield curve, the stock market reacts poorly. Finally, pay attention to the reverse repo market. This is also at the Federal Reserve's website. That's all the data I'm looking to predict. Thanks for watching. Until next time.